When I've spoken before about the Reserve Bank of Australia and the Federal Reserve, I've said the easiest way to understand what central banks are doing is to look at employment growth. When employment growth is higher than the long-term median, then central banks tend to either hold rates where they are or tighten. And when employment growth is lower than the long-term median, then central banks tend to cut rates. And so we thought we'd look at those slides today of where things are and explain what's been happening this week and why it was, in fact, that the RBA held rates where they were and why the Fed cut by 25 basis points. So in the first slide, what you see is the rate of growth of employment in Australia. And the long-term median is 2.3%, but the current rate of employment growth is 2.7%. So it's above the long-term median. Employment growth is strong. That's really entirely because of support from the federal government employing people in the public sector. But as the Deputy Governor of our Reserve Bank says, there's still real jobs. And so the RBA has to take them into account. And for that reason, the RBA is holding rates where they are until inflation continues to fall or unemployment rises, which means if unemployment is rising, that means you can expect that inflation will fall in the future. Federal Reserve, on the other hand, if you look at the rate of growth of employment in the Federal Reserve, the level of actual employment, year-on-year employment, is 1.38%. So employment growth has been slowing as we go through the year, and that's lower than the long-term median of 1.6%. The previous meeting, the Fed cut by 50 basis points, and what I forecast at that time is it would cut again in November and it would cut again in December, and we have just seen a rate cut of 25 basis points. Talking today at the press conference after the statement was released by the Federal Reserve, Jay Powell said that geopolitical risks are elevated, but when we look at the US economy, it is very sound. There is strong growth, a strong labour market, and inflation is coming down. When he was asked about national debt, he said, the national debt is not unsustainable, he said, but the path of growth is unsustainable. That is to say, the size of the US deficit is too big, and that the size of the deficit is making it rise. And if that continues, he says, it will ultimately be a threat to the economy. I believe that since the election of Donald Trump, that what you'll see is if there is significant numbers or sufficient numbers in the House of Representatives, then there will be proposals coming forward to cut spending. We also see that suggestions in cuts will be provided by Elon Musk. Bobby Kennedy wants to cut whole sections out of the Food and Drug Administration. That suggests that there might be budgetary savings available to reduce the size of the budget deficit. We'll wait and see how it plays out. Powell currently holds an appointment until May 2026. Still, he was asked twice at the press conference about resigning. He said if President Trump asked him to resign, would he do so? He replied with a simple no, then asked again if he or other board members could be fired by the president. He said, no, it is not permitted by law. So I think unless Jay Powell is impeached by both houses of Congress, which is incredibly unlikely, Jay Powell will certainly see out his term to 2026. But when asked where he thought that the Fed funds rate would fall to, or where the neutral rate or the natural rate of interest is natural rate was defined back in the 19th century by a Swedish economist called Knut Wicksell, who taught at the University of Uppsala. Jay Powell said, in answer to that question about the neutral rate, we don't know, but as he said, we will know it by its works, which I think is a biblical reference. But we have a model of where the neutral rate will eventually fall to, and we think the neutral Fed funds rate right now, based on where unemployment is now, where inflation is now, and where inflation expectations are now in the US, we think that neutral rate is 3.85%, and that the Fed funds rate will continue to fall until it gets to that level. Just as I said, the Fed cut rates by 25 basis points in November, and that reduced the effective funds rate to 4.6%. We think there will be another rate cut in December to an effective Fed funds rate of 435 basis points, which will be equal to where the Australian cash rate is. But we don't think that rates will stop there. We think there will be a further rate cut on the 28th of January to 4.1%, and following that there is a Fed funds rate Fed meeting on St. Patrick's Day, no less, and there will be a rate cut then, we think, to 395 basis points, which is where our model of where the neutral Fed funds rate should be. Any changes after that we'll have to judge on where inflation, unemployment, and inflation expectations in the US go. If they improve, that is to say, unemployment goes up, inflation goes down, or inflation expectations go down, then rates can be cut further. But right now, we think that the bottom of the Fed funds rate, and how far the Fed can go, is 385 basis points in March next year. Interestingly, the Fed is not just cutting rates, it's also doing quantitative tightening. And it's doing quantitative tightening at a rate of $25 billion per month. That is to say that the size of the Fed balance sheet is falling by $25 billion a month. But that's only $300 billion a year. And at that rate, it will take 9.85 years, say 10 years, for the Fed balance sheet to fall down to the or the $4 trillion that it was in 2019. So the Fed may continue to cut rates until next year, but quantitative tightening is going to be with us for some years to come.